All right. Welcome back to International Finance. I am Andy Kim, your Dr. Finance. We are going to finish chapter 11 of Eun, Resnick, and Chul-Lun. Here, we're going to discuss LIBOR, and then we're going to go through some LIBOR scandal, and then we'll move down to some related issues in global financial market. And then London interbank offer rate is what LIBOR stands for. The reference rate in London for euro currency deposit. There is a LIBOR for euro dollars and euro Canadian dollars and euro yen and even euro euros, right? So you can click this website, right, in your free time. You know, other financial centers, other reference rates are used. It's a benchmark rate, right? Very short-term rate. And for example, SIBOR, Singaporean one, and then TIBOR, Tokyo, I told you before. Euro interbank offer rate is Euribor, is the rate at which interbank deposits of the euro are offered by the prime bank to another in the eurozone. So interbank offer rate, how does it get determined? You may wonder. The institutional details of LIBOR fixing is this. At 11 a.m. every trading day in London, the representatives of BBA, British Bankers Association, LIBOR panel banks get together and give their opinion about the following question electronically. What question? At what rate your bank could borrow in euro currency market today? Okay? Think about your own bank, right? And answer me. At what rate can you borrow your bank? Right? And then they will respond, oh, my bank, right? My proud bank will be able to borrow at what rate? Certain rate, okay? Those member banks, right? 17 or whatever, they will respond as a survey response, right? And then what do? Take out the top 25 rate and bottom 25 interest rate numbers, right? And then compute the average of the remaining 50% in the middle, okay? Then that's going to be the LIBOR rate of the day. Now, the question is, who wants to say a higher number for LIBOR rates? For your own proud bank's borrowing rate. Who will say honestly, right? Over there. That is a serious question, unquestioned before. London interbank offer rate. Yeah, did I say this right? So LIBOR panel banks, 17 of them. You see Bank of America, and then Bank of Tokyo Mitsubishi, UFJ, Japanese Bank, American Bank, and Barclays Bank. And you remember this is London, which is Britain, and then London interbank offer rate. You may think that this has to be British banks that should be the associated over here, right? And then no foreign banks should get in over there because it's London and Britain. But interestingly, you see Japanese banks and American banks, and then you see French bank, Crédit Agricole, and Swiss bank, Credit Suisse, and Deutsche Bank, German bank, and HSBC, right? British bank, and American bank, again, JP Morgan Chase, and Lloyd's Banking Group. Oh my God, it's been a while since I've seen the British bank over here, Barclays, and then Lloyd's Bank, and then Rabobank, another one, and Royal Bank of Canada, Canadian one, Société Générale, which is a French bank, Sumitomo Mitsubishi, Japanese bank, and Norinchukin Bank, that's 농림은행 in Japan, right? You see, for Koreans' perspective, this is a big surprise. Wow, Japanese banks are in among those member banks in the British Bankers Association. Why isn't there a Korean bank? Or Chinese guys will question, why isn't there a Chinese bank? But I'll let you know, like it has been a long time, right? It has been a long time that, Japanese banks have been involved over there in European Financial Center. And they've been, they were the major powers in the empire expansion like 100 years ago or something like that. So that's why long history is required to be over there in the banking. It's like more like a clubby nature in bankers' world, right? Royal Bank of Scotland and the UBS AG is also there, right? Don't take it personal, right? It's just there, okay? It's the reality of the world, right? Anyway, so LIBOR fixing scandal was there, unfortunately, and you're going to see that in your textbook, page 294 to 5, and then Forbes magazine article that I posted on the iCampus, and now they are trying to replace LIBOR system somehow, but let's see. That's gonna be happening in this year or next year, so it's gonna be very interesting to see it. And what was the question? The question every day they ask, right, and answer was like, at which rate your bank could borrow in euro currency market today? Who wants to say higher rate? And that in the middle of global financial crisis in 2008 or something like that, right? Your bank is in danger, which means very risky, high risk, high rate, high return. So interest rate should be high. But they colluded and said very low rate. Okay? Artificially lower rate. And then they just fixed it that way, manipulating the market. That was a trouble. I mean, that was illegal, right? So it brought up a whole lot of scandal. So the CEOs got kicked out, and then those banks had to pay a huge amount of fines, right? And much of the derivatives pricing depended on your survey result of LIBOR every day. Derivatives, 파생상품 시장. Their benchmark rate is again LIBOR, right? And then syndication loan, it's LIBOR based, right? Everything was screwed up. And then not many people noticed that in the middle of financial crisis, because they were focused much more on the unfolding, ongoing crisis. Holy cow, the CDS and CDO, paying less attention to the LIBOR rate itself. Later on, the PhD students from University of Minnesota found out there's something fishy going on in the LIBOR rate. What is going on? So that was how it unfolded. $350 trillion worth of derivatives, right? Nobody is policing you. Who wants to say honest numbers? Collusion, manipulation had happened over there. Big trouble. LIBOR fixing scandal. What's the consequence? I told you. Yeah, all these kind of things happen. It's we're dumping LIBOR in 2021. That's this year, replacing with BTFR, broad Treasury financing rate that contains a broad set of U.S. Treasury market-based financing transactions, also known as repo transactions, repurchase agreements, right? That kind of things will replace it. But let's see. International debt crisis is the next section that we're going to talk about. Some of the largest banks, right, in the banks in the world were endangered when the loans were made to sovereign government of some less developed countries. At the height of the crisis, third world countries owed 1.2 trillion US dollars. Like many calamities, it is easy to see in retrospect that it is a bad idea to put too many eggs in one basket, especially if you don't know much about that basket. I mean, don't invest in what you don't know. That's the message by, who is it? Jim Rogers, not Jim Cramer, Jim Rogers. And then the message or lesson repeats again and again, okay? When it comes to debt crisis, be our guest. Be our guest. Be our guest. 1997 and 98. What do you see? Daewoo Motors, which is one of the biggest corporations or conglomerates, close competitor of Samsung Group or Hyundai Group, right? They fell down, right? They became the victim of this crisis. And then, Daewoo Motors was there. And then this guy, Kim Woo-jung was the head of this group, right? And then there were, with the currency crisis unfolding, we call it twin crisis. When your country suffers from currency crisis, your debt crisis will happen together with it. Because it's not just your currency gets into trouble, your foreign currency denominated debt, right? Foreign banking, will bring you another trouble together with it, because your own currency is devalued, and then your foreign currency debt the value of your foreign currency debt will skyrocket. You'll be heavily indebted, and then the chain reaction goes on, so that your manufacturing or non-banking sector suffers a lot from it, and then that non-banking sector crisis hurts your banking sector as well, right? Simultaneously happens together. We call it twin crisis. Now, debt for equity swap illustration is one thing that I want to talk about in Korea setting. What happened to GM Daewoo, right? That motor company over here during that 1997 and 8 crisis. And what do you see? Well, you see an example, hypothetical company from less developed country, right? LDC stands for less developed country in textbook diagram. In the textbook they talk about Mexican example, and then hypothetical companies that has borrowing IOU as much as 100 million US dollars worth from international bank like this, right? But you can think about this equivalent thing happening from Daewoo Motor kind of things. Low developed companies firm borrowed from outside banks like that, right? Especially short-term debt. They were rolling over short-term debt. They had to repay it in a quick manner, whereas their business was going slow. Anyway, and then leverage was too much. We're going to talk about the leverage issue a little later. Anyway, and then debt for equity swap is a typical situation when this kind of twin crisis happens. Debt crisis happens. Debt for equity swap is like a 출자 전환 in Korean terminology. That's like your company is heavily indebted. Then these creditors, right? Creditors swap their loan into equity. Right? Swap their debt into equity, loan position into debt, so that your creditor bank becomes your equity holders, right? 자본 감자 situation happens. 감자 is not a potato, but the capital reduction, okay? It's never a sweet potato. 감자 is like over here is a bitter one, very bitter one. Your shareholders get kicked out, and your debt holders, the bankers, become your shareholders. So debt for equity swap, okay? That's what happens during this crisis period. How does it happen? Here is a company like Daewoo, and low developed countries, local company or low developed companies like Daewoo, who owes $100 million to a foreign bank, okay? And then they're dead, okay? They're dead, bankrupt. If you leave this company as it is, then its market value will become zero. Even if you liquidate all their assets, there is no way of repaying this $100 million to the international bank or whatever. Now, what happens? Just think about it in the jungle, right? Somehow in the African jungle, then if the elephant dies, 코끼리, right, dies, then what happens? Those scavengers gets in there. Hyenas or eagles will come down and then eat this guy, so that the scavengers will revitalize this ecosystem somehow. Okay, we need some scavengers in the system. Who will do that? Vulture fund. Okay, Vulture fund. Even if it is not international relations, all these job by the Vulture fund is working as a scavenger. Okay, go for debt companies and then buy it, do some debt for equity swap, and then restructure the company, and then revitalize it and sell it expensively. Over here, okay, what happens? Well, equity investor or MNC, the textbook says, the equity investor is like a Vulture fund, like Hudson Advisor of Lone Star, or Camco, or special asset groups of all different investment banks, or Archon of Goldman Sachs, all these kind of guys. They get in here in the picture. What's their job? Well, they first go to international bank, the creditor banks, and say what? Well, you guys are in trouble. Okay, there's no way you will get this $100 million from this guy. Okay, if you wait, you'll get zero. Okay, you cannot recover it. So instead, I'm gonna give you $60 million, 40% discount. Okay, why don't you give me that loan relation? Okay, and then I'll take that, and then they will be, get the $60 million and then walk away happily. Okay, that's better than getting nothing or $30 million or something, which is typical recovery ratio, by the way. And now what do you do with this? Well, they go to central bank because they are, in the end, it's your company. They go to this central bank and say, what? You are in trouble, man, because this is your country's company. And then they owe $100 million to these international banks. And if they cannot repay it, it has to be you that has to repay to these international banks, right? So you're in trouble. But instead of repaying $100 million yourself, here is discounted value out of it, which is 80% discount. Okay, redeem me at the local currency, 80% of the face value of it, so that I give you the loan contract to you. Okay, and then you cancel this relation, and instead you give me $80 million worth of local currency. Okay. Happy, good. Now with this $80 million, what do? Put this money into this troubled company as equity holders. Now, for this company, you don't have creditors anymore, but you have a new shareholder, new owner. I am your boss. And then what do? They restructure this corporation. Sometimes they lay off a lot of employees. Of course, laying off a part of employees is better than firing all those employees 100%, right? But laying off happens. And then restructure their business so that they invest in a more promising industries or revitalize their, equipment or something like that, right? Sell off unprofitable businesses or, somehow they also sell off some cash cows as well to generate more cash out of it. Now, all this kind of restructuring happens. Now, as that's debt for equity swap. There used to be debt relation with this bank. Now you swap it through the central bank and the scavenger Vulture fund. Now you have new equity holders. The equity swap, okay, happens. That's the basic structure of this. Okay. Now, so just to read here, as part of debt rescheduling agreements among the bank lending syndicates and the debtor nations, creditor banks will sell their loans for US dollars at discount from face value to MNCs desiring to make equity investment in subsidiaries or local firms in the LDCs, less developed countries. The less developed countries' central bank would buy the bank debt from MNC at a smaller discount than the MNC paid. Why? Because this MNCs or the Vulture fund, they are not doing this job for free or not. It's not voluntary work, right? They have to make profit out of it. High risk, high return business. So that's why they make money out of it. But in local currency, the MNC would use the local currency to make pre-approved new investment in the LDC that was economically or socially beneficial to the LDC. And then who benefits from it? Everybody benefits somehow, okay? Of course, you wish there would have been no trouble at all, no bankruptcy in the first place. But given that there was a bankruptcy, this is a scavenger work as, to revitalize the ecosystem, okay? The creditor bank benefits. It's better to have a partial recovery of a loan than getting nothing at all, right? And market maker, those Vulture fund, they earn the difference, which is the bid-ask spread, right? $80 million versus $60 million they have to pay to the creditor, right? $20 million they pocket it. Yeah. And then LDCs, right? The corporations. Well, they have two benefits. One is being able to pay off that hard currency loan. You are not able to repay that $100 million in the first place, but that obligation is disappeared. It's gone. So it's good. Number two, the new productive investments take place for your company Of course, it's painful to lay off your part of your labor forces, but it's better than firing all of them, right? And then now you're able to live like a new man, live like a new company, right? So that's that, right? The equity investors, right? They purchased of LDC local currency needed to make the investment at the discount from the current exchange rate. That's another benefit of it. Yeah. Of course, it's a high risk and high return business, right? Some of my, I mean, one of my friend working in this debt restructuring, right? Vulture fund, right? Perhaps the biggest vulture fund in Korea. Recently, hired one intern from our SKKU, and then this is a high risk, high return business. And then do you need like in this kind of business, do you need all this kind of artificial intelligence and all this kind of advanced mathematics? And the answer is no. This is more of a negotiation based business, and then a lot of number crunching as well, but it's not rocket science business. It is really negotiation based ones, right? And the tough job, right? And then high risk, in that sense, political risk is there. Massive layoff of the workforce happens. It will inevitably trigger strikes of the labor unions, and then it will hinder the process of restructuring in many ways. And then political risk afterwards also, after your country like South Korea recovers from the crisis, what happens? The market value of the restructured company increases and the country returns to normal economic cycle. Now, naturally, after restructuring as a vulture fund, you will sell off this company at a higher price than your initial purchase price, by the way, as an equity investor, right? Yeah. What's wrong about that? It's all about market mechanism, but the local people will have a grudging teeth against your investment. That's what happened against Lone Star, and then it's like a 먹튀아니야 kind of thing, and they investigate all these kind of things back again with this new political party getting in. And then, was there any corruption going on? They will investigate in detail about the transactions. So you have to be very careful in doing this. And then the lawyers. I mean, if you try to become a lawyer and then try to go to law school, right? What do you do when you go to law school? This kind of business of working for this asset managers, right? Was there any kind of you have to steer clear of these legal concerns, right? So a lot of law majors work for this kind of vulture funds, right? So have some idea in this respect, please. Then some people will always cast a doubt about whether the company was sold too cheaply. Moreover, somebody will always create conspiracy theory up to the point of creating movies like 국가부도의 날 or something like that. Some of the popular figures will argue against your investment as a vulture fund or debt for equity swap. And then the general public with these populistic and then patriotic sentiment will grumble against your investment many times, right? 국뽕 sentiment, right? After this traumatic experience of crisis or this kind of things. But to me, I'm like, I don't subscribe to this these conspiracy theory, right? Come on, get some sense of market mechanism. Come on. You just have to be rational, and then this is what the market is about, right? You just have to get used to it. Just to be smart enough to, cautious enough to avoid that kind of crisis. Never again. Again, my dream is to, educate well-functioning bankers so that we would not experience this kind of traumatic financial crisis in the country level, right? Or any kind of countries, as long as my students are concerned, in your own country. I hope you prevent this kind of crisis. But that's the thing, the market mechanism. That's what it is about. No conspiracy theory, please. That's my message. Thank you for watching it. And then next video, we're going to talk about the Asian crisis in 1997 and 8 in more detail, and then move down to global financial crisis. Thank you.